for watching. We've got Gary Lynn here today. Gary's a property coach, investor, and business manager at the BNZ. And he's here. We're going to talk about the investor property market, the property investment market, and just to get his thoughts on what's happening, because it's been a super hot market and there's been a couple of changes recently. So thanks, Gary, for dialing in.
Oh, thank you. Thank you for having a chat.
Yeah. So, hey, tell us about what you're seeing in the market. Where are you based in New Zealand, and what are you seeing in that market?
Yeah, so I'm based in Auckland predominantly. A lot of my clients are kind of all mostly North Island. Obviously, most of them are in Auckland, and then some in Hamilton as well. So I kind of know, especially the Auckland and Hamilton market pretty well.
Yeah, and obviously on fire at the moment, right? It's from what seems to be a shortage of stock generally. Would that be fair to say?
Yeah, definitely. Yeah. Storage of stock. I would say even especially development, any properties, especially in Auckland, probably even in Hamilton as well. Anything that can be developed, pretty much mom and dad investors, they all want to be, they all look at the grass on the other side. Development, everybody talks about, huge numbers and whatnot, and they think that's easy money. They all try to chase that gold.
Everyone's a developer in a hot market, eh?
That's correct. Yeah, that's right. Yeah.
And look, I think the thing that everyone's realizing is that a shortage of stock is not something you can solve overnight, right? Like, it's not a thing that you can switch. Suddenly it's really easy to get consent through the council, and like, this is a problem that is going to be with us for a number of years, wouldn't you say?
Yeah, correct. I mean, the thing is, like, it's so the problem is so in terms of limiting supply is so ingrained. I mean, like, I used to be a civil engineer with Auckland Transport and all that, and it's a bureaucracy, not just with AT, but like the council and any organization in general. The bigger they are, the more red tape, the more processes, the more people need to sign off on things. Same as the bank as well.
Yeah.
That's why the banks these days can't cope, even though you say, oh, just hire more people. Well, it's not that easy.
Yeah. If only it was that easy. Yeah.
No, yeah, exactly. So, yeah. So you got the obviously the IMA, I think the government's talking about revamping it, but that's a big beast itself, right? And obviously supply shortages, the supply chain's been disrupted by COVID. Then you got the labor shortages, because obviously overseas people, like a lot of pilots from Philippines and things like that, whatnot, Asia region, they can't get in, right? Obviously, immigration New Zealand, for whatever reason, they're not processing enough, or obviously I'm not in that space, but we seems to have even a bigger labor shortage now. And combination of obviously building materials going up, probably 10% this year. So it's a lot of things that's limiting supply, and there's no easy way out of this, unfortunately.
No, and again, labor shortage is another thing which can't be solved unless, if you can't import people into the country. Take 3 years to train a builder, right? So it's
correct. Yeah, that's right. And then you got the sector of the population will be like, oh, how come we letting people in? We should be closing the border, with this COVID fiasco. And at the same time, it's like, what about the jobs for Kiwis? So it becomes a political hot potato that the government doesn't obviously want to. They know economically we need the needs, but at the same time, politically and also popularity, right? Popularity wins votes ultimately. So the government is, they got to balance both sides. The people, the businesses, and the wealthy people donate to campaigns. And then you got the average Kiwis that they think differently, right? So you got the government has to balance both, which is really difficult.
Yeah. And the other thing is, to build enough houses to sort the shortage out, you need to build them fairly uniformly, would be probably the polite way to put it. But you need to create 100 houses all the same real quick. And Kiwis traditionally don't like that model, right? We don't like those kind of ticky-tacky houses that you can traditionally throw up. And Australia did it, right? They just get a bunch of bricks and they throw up exactly the same house 1,000 times over. But
it happens a lot more it happens a lot more overseas, like in US. You can have whole suburb, a couple hundred houses, and you only got about 3 choices, 4 choices, whatnot.
Yeah.
But ultimately, that's kind of the easiest Well, I mean, it's even like new cars, for example, if it's got too many trim models and all that stuff, then it increases the cost ultimately, right? The architect has to design 10 different specs rather than just 5 or 4.
Yeah.
So everything that costs time and money, the better quality and diverse you want from the housing stock, the more it goes up in price. And ultimately the market, a lot of people think that property market is a bubble, etc. But working from a bank, well, if you don't have the right equity or deposit, you don't have the right income, sorry, we can't lend it to you.
Yeah. That's right.
So it's a very logical market from a banker's point of view.
Yeah, we see the same thing. It's a tick box exercise, but it's frustrating for the people trying to get into that, right? So they have to get that kind of coaching and get them into the right place. So you go to a few auctions in your spare time. What are you seeing there? Is there a lot getting passed through? Are people expecting too much, or are they generally getting picked up?
Yeah, so for my clients, obviously, I give them like a market update every week, inside my own Facebook group. And generally, obviously, the easiest thing is actually you can go by Barfoot auctions. I mean, that even though that's just for Auckland itself, but it kind of gives you a good idea of how hot or cold the market is. And generally these days, you're looking at 75, average about 75% auction success rate. So that's really high. Some auctions you could have like 20 auctions and only 2 got passed in, right? Which is like 18 or sold. So that's pretty good odds. And we're also seeing record prices. Like there was, I shared my own Facebook page. There was a 2-bedroom unit in Mount Wellington. I've got 6 rentals and units in Mount Wellington, right? Not as nice as that one, but that one sold for $910,000.
Wow.
For a 2-bedroom unit. And then 5 years ago, you could buy it for $500,000.
I mean, that 2 bedrooms are in the first home buyers market, right? That's where couples buy with a spare room, and so 910 for a unit, it's crazy, eh? I was just thinking about while you were talking about auctions success rate, I happen to know that, I'm not going to say which real estate agencies it is, but they actually measure them differently. So one will say if an auction doesn't meet its reserve price, but you're negotiated to purchase, they would call that a successful auction, whereas another company wouldn't. I'm not sure everyone knows that actually, but it is quite an interesting way of skewing the statistics. But
but at the same time, like I look at, like you can go to a Barfoot auction website, right? If it says sold, then you got to trust them as sold.
Yeah.
Because obviously they're governed by REAA, right? So you just you got to trust them on that. Otherwise they'll be in breach, right? And the other thing is it could be under contract. So if it's under contract, it says under contract, you just assume that it's going to be sold anyway. Yeah. And ultimately, look, if 1 or 2 doesn't get sold, who cares? Because you got to look at the whole statistics, right?
Yeah. Whether it's 65% or 75%, a high percentage of houses are still getting bought at auction for sure.
Yeah. Well, I mean, the difference is more like 65 versus 70%. Not 55, 75. Yeah.
And speaking of percentages, was it yesterday? LVR announcement, to the surprise of literally no one in the market who's been following the market. No one was surprised, but the Reserve Bank came out and said, hey, 1st of March, 70% LVR for investment properties. 1st of May, 60% LVR. Kind of irrelevant because the banks are already at 60% for their, but kind of an enforced measure. The banks can't adjust it from those dates. They are bound to those limits. So what's your thoughts? Did you think that the investors were a major cause of this problem, of this heated market, or what's your sort of view on that?
Well, you can always find that information online in terms of like the percentage of buyers in the market. Last time I checked, it was really quite a long time ago, probably October maybe last year. And I think the first home buyer makes up to 40% of the market. So that's huge, right? And then investors at the time was only about 20%, something like that. So it's not huge. But obviously that now is obviously probably a little bit more now. So let's assume, say, property investors make up, say, 1/3 of the market. So if the LVR decreased from 70% to 60%, well, you got to remember, last 2 years, house prices have gone up probably 30%.
Yeah.
So
the equity's there, right?
Yeah. So
there.
for the investors like myself, and also for investors who've been around for say the last 5 years, well, the portfolio have gone up 30%. So what's the 10% extra requirement? No problem.
Yeah.
If they can't make it, just get a valuation wherever, and usually you can squeeze it out of it, right? So I think that predominantly in terms of lending, what I'm seeing is it's definitely is going to hurt the beginning investors. And also the LVR doesn't really impact on home buyers anyway. So if you want to buy a new build, whatever, or if you've got good income as a first home buyer, you want to apply for 90% funding, it's still available, right? And so it's not stopping the first home buyers. So there's not much impact there. And then the investors, yes, the requirements are higher, but at the same time, it's going to lock out some beginner investors, definitely. Investors with only maybe 2 rentals, that kind of thing, will probably limit them. For investors with 3 or more properties, generally, if they've been around the block for 5 years, usually it won't stop them. It's more the income that's probably going to stop them rather than equity.
Yeah, I absolutely agree. I think the guys with heaps of equity, so the experienced investors, traditionally aren't the ones that overpay for houses. They tend to invest by the numbers.
Well, we try to drive down the prices.
Well, that's right. Best you can. Yeah. So I think, you cannot blame a hot property market on one particular sector. It's like everything in economics, it is a compilation of several factors, right? But the ones who would tend to overpay would probably be those guys who are now just jumping into the investment market or thinking about jumping into the investment market, were liable to overpay. But my suspicion is that it's going to slightly affect the housing market in terms of maybe stagnating it for a couple of months. But as you say, the first-time buyers have always had this problem of not being able to get enough funding for what they want to buy. So it's interesting times. The good news about the banks bringing in this rule prior to the Reserve Bank enforcing it is that all of those people that had 80% letter of offers for investment are probably going to roll off in the next month or so, and you'll see a real kind of click, I think. Yeah,
and also that 80% pre-approvals, they all vary different between banks. As BNZ, for example, if you back, a couple months ago, if you want 80% lending, well, you got to submit the credit and all that. The process is very difficult, and it's very hard to get approvals. Whereas other banks, I've heard the frontline bankers can self-approve 80%. So that's a massive difference, right?
Yeah.
For example, in the last financial year, or even the last 6 months, I've probably written or draw down like 30 mil. Not a single one is 80%, right? Yeah. Everything is 70% LVR for investment. So, from BNZ perspective, I don't think there's a major impact there. 10%, it's going to shut down some investors, like I said before. But the thing is, like the alternative options, that's more in your broker space. There's definitely second-tier lenders. A lot of second-tier lenders do 80%, 70%, stuff like that.
Well, actually, one that is known for allowing 80% on investment has just announced that they are following the 60% rule. I think they've probably got the whole of New Zealand turn up at their door. So even this time around, the second-tier lenders are starting to make that move, right? So.
I see. I think that's a combination reason as well, not just because they know that Reserve Bank's going to put into place, but the simple fact is they're just overwhelmed.
Yeah.
At BNZ, for example, we had issues at drawing down a property, a settlement on a Wednesday.
Yes. Yeah.
Last year, November, we started having problems on a Friday. We just like drawing down like sometimes 3 times the volume, obviously, and we just couldn't cope. And then obviously gradually start moving to Thursday. We've got Thursday's problem. And last Wednesday, I got drawdowns. I had to get escalated to get them drawn down on a Wednesday. So
always settle on a Monday. The banks are quiet. That's my tip.
Yeah. That's right. Yeah. And hopefully they had a good weekend and no hangover.
That's right. Yeah. So, what's your predictions? I mean, everyone wants to know what interest rates are doing. HSBC just announced their 1.99%. What's your prediction for the end of 2021, where we're going to be seeing it?
Well, obviously, there's like,
Crystal ball
and,
gazing.
and at the same time, even I'm not a financial advisor, right? So I mean, at this point, obviously a lot of economists are still predicting interest rate is going to be low forever. I guess the question really is that Reserve Bank OCR is already 0.25%. They can't really decrease it any further. But the thing is, like, what I'm seeing is obviously you got the funding for lending program that came out in 4th of December or something like that from the government. So basically the central bank, Reserve Bank, can lend to the main banks at 0.25%, right? And then the bank, obviously, like, I don't work in treasury bank, right? But the thing is, like, the bank generally borrow a majority of its funding from term deposits. So, 1 year term deposit might be at 0.9%, 0.8%. And then now it dropped to 0.25% if you can tap into the Reserve Bank funding. Ultimately, that's my math is terrible now, 6.65%, something like that, 0.6% margin. So theoretically, if the banks, hopefully I don't step in line, out of line in terms of the banking thing, but from a business point of view, that means that the banks can drop their retail rates by 0.6% and maintain the same profitability.
Yeah. Always follow that with in theory, because
in theory, of course,
theory,
right?
they
in theory,
could. Yeah.
And ultimately, at the same time, if you look at in terms of the global kind of what the reserve banks are doing. For example, I've seen I think it was a report by St. Luciana or something like that, the Federal Reserve of America. They published some report saying that's like 40% of US dollars been printed in 1 year alone. Right? And then imagine 250 years prior, all of a sudden 1 year prints out 40% of the total US dollar in circulation. And what that means is the US dollar is pretty much devalued by 40% if you look on that logic. And then that extends to all the currency in the world, because everybody's look up to the big brother, big Uncle Sam. Basically every other currency, every other Reserve Bank have to print 40% just to maintain parity with the US dollar. And then you have all this slush funds in the world looking for real assets to invest in to get a return out of. So supply and demand is my personal feeling is that the debt is going to get cheaper if the central bank continues to print like this. Obviously, you've got inflation. Inflation start to tick up, right? And kind of offset some of that funding drop. But at the same time, the key thing is that a lot of people talk about inflation, but the thing is, house prices are not in inflation, part of the inflation measure. That's why our inflations are low single digits.
They're not part of the basket of goods. Thank goodness. Exactly. Otherwise, our inflation would be about 8%.
No, probably would be double digit back to the 70s.
Yeah, that's right. Yeah.
So yes, there's some pressure in terms of the inflation building up, but I think that's still within the Reserve Bank guideline, like between 1% to 3%. So I think that we're nowhere near 3% anyway. So I don't think, especially you got to look at, this is more global economics, but if you look at Europe, if you look at UK is still in lockdown. They've been locked down like 3-4 times this past 12 months. And that's going to devastate the economy. I mean, New Zealand's obviously very thankful. We only have kind of 1.5 lockdowns. So Europe is still in big trouble. Obviously America, right? There's no really lockdowns, consistent lockdown in America. So the coronavirus is impacting the Northern Hemisphere much, much more. And the thing is, the global economies are generally, those bigger countries, bigger economies are owing the Northern Hemisphere. So there's still a lot of foreign, overseas uncertainty flowing there. I just don't think that the Reserve Bank will play around with the OCR or the interest rates, right? I think that they're more likely to keep it lower for longer, just in case.
About because business confidence, isn't it? So
correct.
For those who are exporting or involved with tourism or anything around that area, it's about maintaining business, and that's fundamentally what it is, right? Like why though that OCR translates through to residential mortgages. But the property market's on a tear. So typically, if everything else was normal in the world, they'd be raising rates at the moment. But they've got to keep that business confidence high, which is why they're pulling all these other levers with LVR and responsible lending, high servicing calculations. So can you afford that mortgage at 7% or 6%? That's why they're pulling all those other levers, not interest rates. Yeah, no, it's a very strange world at the moment for sure.
Yeah, because that lever, that OCR lever applies to business loans as well, right? So you're gonna obviously try to limit if they raise that lever, they're gonna try to contain the house prices. But at the same time, they're gonna make they're not gonna help struggling businesses. And New Zealand, we still got an issue with obviously tourism, international tourism, and you still got education sector. You know, the overseas students market. These two sectors make up at least, you know, probably 30% of the New Zealand economy.
Yep.
And these two sectors are really in trouble right now, right? Because we just don't know when the border opens.
Yeah.
So and then every other business around that, especially if you look at Queenstown, pretty much the whole town was built on tourism. So literally the whole town of Queenstown is struggling.
Yeah.
So it's very strange, obviously, how the economy is kind of bounced back in certain sectors, but at the same time, you still got sectors like that which is struggling big time and needing bailouts and all that stuff. So I just don't think that the central bank will play around with that lever.
No.
They just can't afford that. And obviously, also, you know, confidence, consumer confidence ultimately lead to economic confidence. Yes. And confidence is like a freight train, right? Freight train is that the momentum takes a long time to build up, and also if you try to, you know, apply the lever too suddenly, etc., if you apply the brakes too fast, bad things happen, right? And then the consequences happen. So that's something like if I were a central banker, I would weigh towards more, you know, just leave it as it is, you know, see it economy continue, you know, get out of this COVID first, then okay, then we can look at potentially levers and things like that.
Yeah, absolutely. Okay, so final question: if you could travel anywhere in the world, where would you be planting yourself right now? Where would you be hanging out?
In the current state, no, I won't be traveling
nowhere. Yeah,
no,
let's say the coronavirus was gone. Where would you be hanging out?
Well, I think if coronavirus is still around, I'll go to Queenstown. Queenstown is a nice place, you know, contribute to the local economy.
Yeah.
If the gates are open, obviously, if everything returns to normal, which probably unlikely, Italy, if that's definitely the place I want to go to. Yeah, Italy.
Yeah. Well, I mean, it's a remote working world now, so we can all aim to be working from our favorite place. So we're gonna make those plans when the borders open again.
Well, if I'm going overseas or holiday, I'm gonna switch off.
Yeah, well, that's true. Yeah. Hey, all right, Gary. Hey, tell the viewers and the listeners how they can get hold of you if they want to have a good old chat about investment property.
Yeah, so you can follow on my YouTube channel. I guess you can Google Gary Lin YouTube or property YouTube will show up. I've got like over 100 videos on that talking about, you know, different things about property. They can follow my Facebook page, but also my website garylin.co. It's just my contact details are all around there. If they really want to get in touch with me, they will find it, right? So
yeah, that's the goal. Cool. Hey, thanks for dialing in. It's been great to chat with you. Cheers.
All right, thanks, mate. Cheers.